What's going on, everyone? Charlie here. We're going to talk about FTDs and naked shorting in great detail. Now, I know that it was supposed to be about GameStop specifically, but the only thing we know is that they've been failing since 2005. There's a shit ton of them, no way to tell the exact amount, and I think you'll learn where they could possibly be and what's been going on with them not being settled after watching this presentation. So let's take a look at FTDs and naked shorting. Let's go. So, introduction, naked short selling. Naked short selling, in other words, selling a stock short without borrowing it and subsequently failing to deliver the stock at settlement, has recently caused much sensation. Critics claim that naked short selling is used in abusive trading strategies and manipulative attacks on companies, which we all know they very well are. Disgruntled Wall Street veterans, company directors, and shareholders have blamed naked short sellers for the collapses or near collapses of several companies and gone so far as to establish organizations to campaign against naked short selling, for example, the National Coalition Against Naked Shorting, or NCANS. Regulators such as the SEC have responded with a frenzy of additional rules and temporary bans that have done absolutely nothing, you're welcome, Morgan, on several occasions stating their concerns about naked short selling. FYI, wasn't sure, again, how to exactly research GME-specific FTDs, as there's no telling where they could be other than the puts that we see January 22. Now, if you would like to know more about GME and FTDs as far as its history, I have already covered this in a video. It's actually on my main channel page for returning subscribers. So if you want to go check that out, I would recommend doing so. Now, despite the widespread criticism, not all naked short selling is abusive. Some naked short selling occurs unintentionally when a short seller, in line with current regulation, locates shares to borrow or has reasonable belief that shares can be located and borrowed, but for some reason is unable to borrow the stock in time for delivery. Further, some naked short selling is due to market making. So, naked shorting, the benefits, it brings liquidity, which obviously is probably what they're doing, because if you look at the market, there's no liquidity, reduces time and effort, checks the cost of borrowing. And limitations is market manipulation and failing to deliver. Now, a failure to deliver occurs when the seller of a security does not deliver that security to the buyer within the standard 2-day settlement period. Naked short selling is one way that this can occur. FTDs can also arise from various processing errors, delays in obtaining physical stock certificates, wink wink, or human error in entering the incorrect stock symbol. As one might expect, the number of FTDs is correlated with the overall trade volume, but also exhibits some meaningful deviations. Fail volume decrease between 2004 and 2007. Historically, it increased rapidly during 2007 and 2008 and declined substantially at the end of 2008. For most of the period between 2004 and 2009, the number of FTDs for stocks listed on the main U.S. exchanges is between 1.5% and 5% of whatever stock it is average trading volume per day. Now, GameStop has been failing to deliver since FTDs were first reported in 2005, which shortly after the FTD started reporting is right after the unlisted trading privileges plan became a thing. Where are they? They could be anywhere. Let's look at traditional short selling now. Hold on, I gotta change this because I gotta do the morph. You gotta do the morph on this, right? Because if you don't, it looks stupid. Morph it. There we go, daddy. Now it should look better. Oh yeah. Traditional short selling. Traditional short selling involves a seller borrowing stock they do not own from a broker or institutional stock lender and selling it. The buyer receives the stock previously owned by the lender and is usually unaware that they transacted with a short seller. Often, short selling is a bet that the stock's price will fall and the stock will be able to be bought back at a lower price and returned to the lender, earning the short seller the amount of price decline less the cost of borrowing the stock. When a short seller borrows a stock, whether it is from the broker or from an institutional lender, they typically leave the proceeds of the sale, and often a certain percentage more, with the lender as collateral for the borrowed stock. The lender can invest the cash collateral, earning interest. The borrower usually pays a fee to the lender that depends on the availability of the stock. This fee is often only about 10 basis points per annum for easy-to-borrow stocks. In a competitive lending market such as that of the U.S., institutional lenders often pay institutional borrowers interest on the cash collateral, known as short interest rebate, in order to obtain their business. Now, here's a diagram of how the shorting works. So, step one, the short seller borrows a stock from the broker. Short seller borrows AMC GameStop from a broker. Step two, short seller immediately sells AMC or GameStop into the market. Step 3, the short seller buys back AMC or GME from the market, often at a lower price. Short seller returns the borrowed stock to the broker, making the profit of the difference. Now let's look at naked short selling. In naked short selling, the seller does not borrow the stock and as a result fails to deliver the stock to the buyer at settlement. The fail to deliver typically occurs 2 business days after the naked short sale due to the T+2 settlement used in the United States. Now, there's 2 possible reasons for intentionally engaging in naked short selling. Number 1, to short sell stocks that are difficult or impossible to borrow. And number 2, to conduct manipulative bear raids on stocks. We've probably been seeing that go on in both fashion this year. At first, it was likely number 2, and now we're seeing it as number 1 because it's probably very difficult or impossible to borrow these shares unless somebody just recently got given a large pool of shares. But we won't go there in this video. Anyways, when borrowing costs are high, market makers sometimes choose not to borrow and instead naked short sell. In such cases, naked short selling, then failing to deliver, is economically equivalent to borrowing shares at a zero fee, zero rebate equity loan, plus the expected cost of being forced to buy back the stock and deliver it, a process called buying in. In difficult to borrow stocks, this amount can be less than the cost of borrowing. Critics of naked short selling and many companies that claim to have been targets of manipulative short selling attacks argue that naked short selling can be used to conduct bear raids because naked short sales artificially increase the supply of shares in the market. Because naked short sellers do not borrow the stock, they can theoretically sell an unlimited volume of stock into the market, driving down a share price. Traditional short sellers, on the other hand, are limited by the amount of stock they can locate to borrow, which can become limiting as the level of short interest becomes large. So that could explain why we don't see the short interest anymore, because they're entirely naked shorting it, because they can't short it, again, because there's no shares left to borrow, or not borrow, to short. I'm sure that the borrowing, and I know it's the borrowing that's been going on. Now, who facilitates the borrowing is the important part. Organizations involved in clearing and settlement. This section is huge. So, through its subsidiaries, the Depository Trust and Clearing Corporation, DTCC, provides clearing, settlement, and information services for equities and other securities traded on U.S. financial markets. One of its key roles is to reduce counterparty risk by guaranteeing, keep this in mind, it guarantees obligations will be fulfilled. It centralizes, automates, and standardizes the clearing and settlement process. 2 DTCC subsidiaries that we should all know very well by this point that play important roles in these processes are the National Securities Clearing Corporation and the Depository Trust Company. I almost said it. Anyways, the NSCC fulfills the clearing role, or the computation of obligations to be settled, and serves as the central counterparty for trades in the United States securities market. In doing so, the NSCC guarantees completion for virtually all broker-to-broker trades involving equities. Remember, there's a guarantee. In its clearing role, the NSCC is responsible for multilateral netting of trades and payments among its participants, thereby reducing the number of payments and securities that are exchanged. This function also serves to reduce counterparty risk. Trades are netted in the continuous net settlement system, something that the SFT system will not be clearing trades with. That is why I'm so jacked for it. The NSCC has roughly 4,000 participants and is regulated by the SEC. Now, the DTC, which we should all know very well because of some recent events, in fulfilling its role facilitating settlement, the actual transfer of securities and cash between buyers and sellers, maintains a centralized store of stock ownership records. Today, these are largely electronic records, although the DTC is also a store of physical certificates, the ones you all gave them when you went to and cover a large proportion of all U.S. listed stocks. The DTC is responsible for transferring stock ownership, usually by making electronic book entry changes to reflect NSCC's net settlements or instructions from other trade matching services or participants, as well as transferring money between participants, brokers, and broker-dealers. The DTC does this by debiting and crediting participants' securities and money settlement accounts held at the DTC. The DTC is registered as a clearing agency with the SEC and monitors its participants to ensure compliance with DTC's rules and procedures. The SEC conducts an annual inspection of DTC's data processing areas and has conducted an inspection of selected operating areas every other year. Maybe we should do that every year, Gary. Now, here's a little diagram of how the central bank and net settlement works and the settlement mechanism. If you wanted to pause and take a look at that, basically you have indirect participants or in a direct participant, okay? So your banks are your direct, your indirect participants are your transfer agents, your broker dealers, things like that. And then your prime brokers are your direct participants. Now, clearing participants include brokers, broker dealers, banks, and insurance and investment companies. They are bound by the rules of the NSCC and DTC. They are bound by the rules of the NSCC and DTC if they are a participant and pay fees to the clearing organizations, which participants in turn may pass on to their clients. Figure 2 illustrates simplified interactions between key parties in a typical stock transaction. Now, procedures. An algorithm run by the NSCC determines which of the participants with long positions, participants that are owed stock by the NSCC, did you hear that? Owed stock by the NSCC, due to be settled that day, will receive stock. The algorithm works by allocating shares in the following order: priority groups in descending order, age of position within a priority group, and random numbers within an age group. Participants can request that they be given priority to receive stock on a standing or override basis. Although participants that submit buy-in notices or request to receive stock owed to them receive priority with buy-ins due to expire that day, given priority over buy-ins due to expire the following day, which in turn are given priority over priority requests and priority overrides. Each member's random number is different in each security and is generated daily by a computer. The results from the algorithm are sent to DCC and subsequently during the second phase of the settlement or the continuous day cycle. The DTC transfers stock from the NSCC's account into the stock accounts of the participants with long positions selected by the algorithm. Now, for CNS deliveries or continuous net settlement, cash transfers do not occur simultaneously with stock transfers. Cash, credit, and debit entries are made to participants' money settlement accounts, netted at the end of the day, known as settlement netting. This differs from the exposure netting done by the NSCC. And finally, any net credit balance is transferred to the participant, and any net debit balance is transferred from the participant through the Federal Reserve's money transfer system called FedWire. The transfers occur between DTC's account at the Federal Reserve's Bank of New York and the participants' settling banks. If no participants fail to deliver on their short positions, for example, the DTC is able to transfer all of the stock owed by participants to the NSCC account, and there are no open failed positions from previous days, then all participants receive the stock they are owed by the NSCC. In this case, there would be no open long or short positions carried forward in time. What happens when a fail occurs? If a participant is unable to deliver on their net short position or stock owed to the NSCC, the position is called a fail to deliver, or FTD, and the short position remains open. The failure to deliver may be because the seller does not own the stock or simply because of an administrative delay in obtaining the stock ownership records. For example, when physical certificates have to be found. So think about that. Who just found a bunch of physical certificates because we were all like, here you go, take it. You can have MOAS. No. Anyways, you know the answer. When participants fail to deliver stock, the NSCC receives less stock than it owes and consequently may not be able to deliver stock to all participants with long positions. The long positions for which the NSCC is unable to deliver stock remaining open long position are called failed to receive. This can be thought of as an IOU from the NSCC to the participant with the long position, and similarly, the FTD can be thought of as an IOU from the participant with the short position to the NSCC. Dividends are automatically debited from participants with FTD positions and credited to those with FTR positions. However, shareholder voting rights are distorted because FTR holders, participants with stock IOUs from the NSCC, do not receive the usual voting rights that they would had the stock been delivered. Well, we all know this isn't true in the case of being, with a broker, because we all participated in the proxy voting this year and we came back with 0 non-broker votes. So that's good to know. They are also unable to lend the stock until they actually receive it, by the way. Most often, the clients of participants with FTR positions are not aware they have been credited an IOU as opposed to an actual stock because their stock holding account does not distinguish between the two. Only the NSCC and the participant are aware of the difference. Only the NSCC and the participant are aware of the difference. Participants with FTRs are able to sell them just as if they were ordinary shares because the buyer is also not aware that the seller is yet to receive the stock owed to them by the NSCC. When this occurs, the fail to receive is simply passed on in the continuous net settlement system as an IOU of stock from the NSCC. The buyer does not necessarily end up with the IOU due to the randomization in the algorithm that allocates stock from the NSCC. FTDs are owed by the NSCC and the DTC, not the participants. Isn't that crazy? Much wow. When a participant receives a fail to receive, or the IOU from NSCC, cash is still debited from their account even though they have not yet received the stock. However, instead of being paid to the participant with the FTD, it is held by the NSCC as collateral until such time as the stock is delivered and the FTD is canceled. The amount of cash collateral held is not the cash value of the stock bought or sold, but rather is the marked-to-market value of the stock reset daily with cash adjustments. The cash adjustments are made from the money settlement account of the participant that failed to deliver the stock. As a result of the daily marking to market, the cash collateral approximately tracks the cost to the NSCC if it had to purchase the stock to deliver the participant with the FTR, or fail to receive. Critics of the NSCC claim that a potential danger of this system of market to marking the cash collateral is that in the case of fails caused by naked short sellers conducting bear raids as the price of the stock falls, the naked short seller is able to withdraw the cash adjustments and leave the NSCC heavily under-collateralized for the true value of the stock. However, this is not possible because the level of collateral held by the NSCC cannot decrease when prices fall. It can only increase when prices rise. Stock borrow program, what we're looking at next. Now, get this shit. The mechanism the NSCC has in place to reduce the number of fail to receives but does not reduce fail to delivers is the stock borrow program. Under this program, participants are able to lend excess stock in their DTC accounts to the NSCC so that the NSCC can satisfy delivery requirements not filled via normal deliveries. Each day, participants submit a list of stocks they own they would like to have participate in the stock borrow program. Once the NSCC determines the open long positions or stock it owes participants that are due to become FTRs or fail to receives, it attempts to satisfy these obligations by borrowing from participants in the stock borrow program. If there are more potential lenders than the NSCC's borrowing requirement, the NSCC determines which lenders it will borrow from using, you guessed it, an algorithm that takes into account participants' average loans and clearing fees. When the NSCC borrows stock from a participant, it credits the participant's money settlement account with marked-to-market value of the borrowed stock. Recall, this is the same as the collateral held from the participant that failed to deliver the stock, or the purchase price from the buyer and mark-to-market cash adjustments from the failing participant. So effectively, the NSCC is simply acting as a facilitator of lending between the participant failing to deliver and the participant lending their stock. The participant lending stock may invest this cash collateral to earn interest overnight and does not have to pay a rebate on the interest as in normal competitive lending markets, thus making participation in the program attractive. This process is reversed when the NSCC returns the borrowed stock. Well, guess what? The stock borrow program was discontinued. You know why? Because we're getting the SFT service soon, and guess who's been filling in for the NSCC while they've had no stock lending program? You guessed it, the Federal Reserve, which explains the repo. Its share lending has been all year long. Although the NSCC states that the purpose of the stock borrow program is to cover temporary shortfalls in CNS, there is no time limit on how long NSCC may borrow stock from its participants. The use of the stock borrow program does not eliminate the delivery of obligation of participants with FTDs. At least it used to not. In 2005, the stock borrow program was able to resolve approximately 20% of failed to receives. In the remaining approximately 80% of the cases of the FTRs persist in perpetuity. I'm an idiot. I can say this word. It's freaking me out right now. Perpetuity. You know what? Perpetuity. God dang it. I swear. Okay. The FTRs persist in perpetuity and are passed on from one participant to another as stocks are traded. For FTDs caused by naked short selling, the situation resulting from the stock borrow program is equivalent to the naked short seller borrowing stock from the stock borrow program participants at a zero fee, zero rebate loan and short selling the stock to the participants that would have received FTRs in the absence of the stock borrow program. The stock borrow program has been criticized for allowing naked short selling to persist. Interesting. Conclusions. A few conclusions can be drawn from this overview. First, from a naked short seller's perspective, naked short selling is economically equivalent to a zero fee, zero rebate loan to the naked short seller from a participant that involuntarily fails to receive shares. The algorithm that allocates shares to participants after multilateral netting passes existing FTRs to participants with more recent long positions. Therefore, the participants that effectively act as involuntary stock lenders in this arrangement change as shares are traded. When the stock borrow program resolves a naked short seller's FTDs, the situation that arises is economically equivalent to a zero fee, zero rebate loan from the stock borrow program participant to the naked short seller. Now, this is my theory based on everything we just read. The stock borrow program, since it doesn't exist right now, is the Federal Reserve. Okay? Now, second, from the buyer's perspective, buying from a naked short seller does not necessarily result in failing to receive the stock at settlement. The algorithm that allocates shares is equally likely to allocate the resultant FTR to any of the other participants that bought the same stock on the same day, assuming normal priorities. This further suggests that a buyer may fail to receive shares at settlement even though the seller delivered the shares at settlement. Buyers that receive an FTR during settlement rather than the actual shares are unlikely to be aware of this. They have most of the rights of buyers that receive shares during settlement, for example, entitlement to dividend payments and right to sell the stock, but not all of the rights, for example, no voting rights and no entitlement to lend. Thirdly, given the way in which the settlement procedures reallocate fail to receives and the finding that FTDs represent approximately 1 to 5% of daily traded volume, only in rare circumstances or in very infrequently traded stocks would a participant have an FTR for long enough to initiate the buy-in process, let alone complete it. Further, if a buy-in is completed, the participant forced to purchase the stock is not necessarily the same participant with which the buy-in notice originator traded. So it's very convoluted. You can't keep expecting on this system of FTDs to work. We can't keep expecting any of this system to work, especially, anyways. Okay. Finally, the U.S. clearing and settlement system does not provide any significant disincentives for naked short selling. The buy-in procedure, on the rare occasions that it is used, is unlikely to force a naked short seller to close out the FTD. The stock borrow program effectively facilitates a zero fee, zero rebate loan to the naked short seller, and the fees for failing are insignificant. Therefore, they're going to keep doing it because it works in their favor. It always has. So how many FTDs are there for GameStop, and where are they? They're owed to us by the NSCC, DTC, and lost in the cluttered mess, of course. However, if you want to go and look where they could be, I believe that the FTDs, since there's no stock borrow program, are either being stuffed in the repo market or they're being stuffed in married calls and puts. Go look at January 2022 puts at the 0.5 strike price. Tell me what you think. Hope this video helped. I hope you learned something. Sorry I'm retarded and can't pronounce shit. Have a good one.